Last month, a client said to me, James, if I want to be in the best financial position at retirement, should I be prioritizing investing or repaying my mortgage? Well, if average stock market returns end up being 9% and your interest rate is 5%, it's likely that you'd be better off. James, I get that. But isn't that a bit simplistic? Surely there's a link between interest rates and stock market returns. And what happens if there's a stock market crash right at the end? I know the future will be different, but can we not look back in history? Look at real periods of time to find out how often I would have been better off investing and by how much. What do those periods look like, and do they look anything like today? I know the past is no guarantee of the future, but seeing that data would give me a better sense of the potential upside and the risks. And I thought, that is a really good idea, because every other attempt that I've seen at trying to answer this question uses linear return assumptions based on historical averages. If stocks return an average of 9% per year and your interest rate averages at 5%, you'd be better off investing. But that is a gross oversimplification, because in reality, stock returns and interest rates are not constant. They are very volatile, and these averages hide so much of that detail. But I have never seen any data on this. So over the last few weeks, I've done an analysis of 50 years of stock market and mortgage data, going back assessing each period to understand whether you'd be better off investing or paying off your mortgage. And what I found really surprised me, because there was one particular investing strategy that would not only have left my client better off in every scenario that I looked at, but would have left him an average £200,000 better off at retirement. What's even more interesting is that visualizing the data in this way helped my client to decide that this strategy is not actually for him. It will be right for some people, but it wasn't for him. So in this video, I'm going to walk you through this data. I'm going to show you what has worked in the past and what hasn't, and most importantly, help you to understand the risks so that you can decide whether you should be investing or paying off your mortgage. Hello and welcome back to the channel. If you're new here, hi, my name is James. I'm a financial planner, and this is a place where you can learn to make smarter financial decisions. We're going to be looking at this through the eyes of my client, but to help you apply this data to your own situation, we're also going to look at the effects of different mortgage sizes, using different investment accounts and investment strategies. And if you have enjoyed my other highly analytical videos, you are going to love this. So let's get stuck in. My client, let's call him Tom, is 45 years old, works in technology sales, and has a mortgage balance of £200,000 with 15 years left on its term. His fixed term is coming to an end, and just like you, he's trying to understand whether he should be prioritizing paying off his mortgage or investing. He wants to know which is likely to leave him in the best position at retirement. Tom has a low loan to value of less than 50%. So at the time of recording, the best 2-year fixed rate that he can get is 4.5%. With a repayment mortgage, that would cost £1,530 per month. The specific question that Tom is asking is, what if, instead of using a repayment mortgage, he used an interest-only mortgage, which would have lower monthly payments and free up cash flow that he can use to invest, with the hope that by the end of the mortgage term, his investments have grown enough that he can pay off his mortgage and have a surplus left over. That's what would count as a success. An interest-only mortgage would cost him £749 per month, giving him £781 per month or £9,372 per year to invest. But instead of us making linear assumptions about future stock returns and interest rates, what we want to do is backtest this plan against real stock market data and interest rates from that time to see how often it would have been successful. But first, we're going to need some market data. As a proxy for global stock market returns, we're going to use the MSCI World Index, which is the longest running global stock index, and I've been able to get GBP data going back to 1972. You can buy index funds that track this index, but of course they have fees. So to make this more realistic, I've assumed that there's an annual fee of 0.5%. For historic mortgage rates, we're going to use Bank of England data. Prior to 1995, they only provide an average of rates across banks and building societies. There's no segregated loan-to-value data. But from 1995, I've used the 2-year fixed 75% loan-to-value dataset. Given that Tom and most people seriously considering this would have a lower loan-to-value than that, I would have preferred to look at 60% loan-to-value rates, but that dataset only goes back to 2011, and it's not that much cheaper than the 75% rates. As you can see, this 50-year period includes the high inflationary, high interest rate environments of the 70s and 80s, where interest rates were above 10% for 20 years. So it'll be really interesting to see how investing fared during those periods. But it also includes 5 different stock market crashes. And again, we want to see how that affects the results. To show you exactly how this works, let's zoom in on one 15-year period between 1991 and 2005. The average mortgage rate in 1991 was 12.76%, meaning that if Tom had a repayment mortgage, it would cost him £2,503 per month, whereas if he had an interest-only mortgage, it would cost him £2,132 per month, giving him £371 per month to invest, or £4,500 per year. To make the test fairer, instead of assuming that this rate is fixed for any period of time, we're going to run this like he's on a variable rate mortgage. So the next year, in 1992, when the rate falls to 10.61%, his comparable repayment mortgage would fall to £2,233 per month. The interest-only mortgage would fall to £1,768 per month, giving him £5,567 to invest across the year. And we follow this same process throughout the period. To start off with, we're going to assume that Tom invests his money through an ISA, so it grows free of income and capital gains tax. Over this period, the average interest rate was 6.75%, whilst the average annual stock market return was 10.26%. So if we were doing a simple linear extrapolation of this, it would suggest that over these 15 years, Tom's ISA should have grown to £259,000, leaving him with a £60,000 profit. But the reality was very different. And this is where you're going to start to see why using averages can be so deceiving. He was only up £3,000. Some of you will be looking at this thinking that's a success. And yes, technically it is a success. But I know others will be thinking, was that really worth it? This cuts to the heart of this video, and that is the question that I want you to keep asking as we go through this. So if we follow this same process for every 15-year period over the last 15 years, these are the results. To be clear, what you're seeing here is the figure that would be left after Tom has repaid his mortgage. Let's pull out the key points. On average, Tom would have been left £50,000 better off. But obviously, averages can be deceiving, as there have been a large range of outcomes. In the period ending 2021, Tom would have been left with almost £235,000, whereas in the period ending 2002, he would be down 60 grand. When I showed this to Tom, he said it's really interesting to see that the stock market still did well during the 1970s and 80s, when interest rates were running at well above 10%. Although interest rates were high during that period, stocks did even better, averaging 15% per year. I wasn't so surprised by this because this is what investing theory predicts. When interest rates rise, asset prices tend to fall, which is what we saw happen in 2022. But if interest rates stay high and remain stable, we would expect stocks to deliver higher returns. So high interest rates are not necessarily bad for stock markets, and neither are low interest rates, as we can see that the best performing periods have been in recent years, where interest rates have been rock bottom. So it's not high interest rates that are causing the failures. The problem is when stock market crashes happen right before Tom needs to repay his mortgage. When Tom looked at this data, it made him realize just how much information is hidden behind long-term stock market averages, and that even though things have been good recently, there have been long periods where investing would not have been optimal. The more risky something is, the higher the range of potential outcomes it can produce, which is exactly what we're seeing here. But I know that some of you might be looking at this and thinking, that still looks like a risk that you'd be comfortable taking, maybe just with a portion of your money alongside other investments, whereas others will be looking at this thinking, that is definitely not for me. So as we go through this, please do let me know your thoughts down in the comments, because it will be great to see a range of different opinions and why you think this may or may not be suitable for your circumstances. If you're wondering what these results would look like with different mortgage sizes, You just need to multiply these figures by the ratio of your mortgage compared with Tom's. So if you have a £400,000 mortgage, you would double the values that you see here. So in 2008, instead of being down 45k, you'd be down 90. And in 2021, you'd be up £470,000. Now let's look at another way that Tom could choose to invest his money. If Tom has, say, £1,000 per month of free cash flow that he can invest, instead of investing via an ISA, Tom could invest in the same thing, but through a pension, specifically a defined contribution pension. He can either make a contribution to a SIP, and the government would then add 20% basic rate tax relief, leaving him with £1,250 inside the pension. As a higher rate taxpayer, Tom would have to claim higher rate tax relief via a self-assessment tax return. But to avoid having to do this and to be even more tax efficient, he could instead choose to sacrifice an equivalent portion of his salary into his workplace pension. So if he sacrifices £1,000 per month of his take-home pay, not only does he save 40% income tax, but he also saves 2% national insurance, meaning that he would end up with £1,742 per month going into his pension. As a side note, not all employers offer a salary sacrifice pension, but most do. It is the most common type of DC pension. Again, let's zoom in on that 1991 to 2005 period we looked at before, which shows us that if Tom did this, by the end of the period, he would have far more money in his pension than he would an ISA. The only problem is that he's going to have to take his money out of his pension to pay off his mortgage. In 15 years' time, when his mortgage comes due, Tom will be 60 years old, which is also when he wants to retire. So to pay off his mortgage, he can draw down 25% of his pension as a tax-free cash lump sum, giving him £87,000. But he needs to then draw the rest from the taxable part of his pension. To be tax efficient, it would make sense for Tom to do this over a number of tax years. He could even make sure his mortgage term ends right after the end of a tax year so that he can straddle his withdrawals over 2 years. But to be conservative, I'm going to assume that he doesn't do that and decides to draw it all out in 1 year. I also don't know what other income he may have coming in at that time. So again, to be conservative, I'm going to assume that he pays 40% tax on the lot, meaning that he'd need to draw an extra £187,000 from his pension, leaving him with £75,000 left over once the mortgage is paid off. And if we follow this process for every period in our data set, these are the results. It has the same pattern as with the ISAs. All of the best and worst performing years align, but he has more left over or less of a loss in every period. On average, Tom would be £216,000 better off than if he'd stuck with a repayment mortgage. And there were only 2 years that were technical failures. On seeing this, Tom said that this really demonstrates just how powerful pension tax relief is for boosting returns. And I agree, but it could have been even better. When you choose to sacrifice more of your salary into your pension, not only do you save on national insurance tax, but so does your employer. And given that you're the one that's saving them that money, they may be willing to pay that saving into your pension. Not all employers are willing to do this, but fortunately, Tom works for an employer who does, meaning that for every £1,000 a month of net pay that he gives up down to the basic rate tax band, he'll end up with £1,962 in his pension, 13.8% more than before. And with this, the results look even better. Now, there is only one period that is a technical failure, and in other scenarios, he's ending up with over £500,000 left in his pension. Although this is interesting, I didn't want to dwell on this for too long because Tom might not work for this employer for the rest of his career. So we went back to use the standard salary sacrifice as our base case. Out of interest, Tom asked how this would look if he was 5 years older and only had 10 years left on his mortgage. Well, if he still had a £200,000 mortgage at the time, these would be the results. Here, it's interesting to see that the high interest rate environments of the 70s and 80s were almost as good for investing as the last 15 years, when interest rates had been rock bottom. What you'll also notice is that compared with the 15-year periods, the upside scenarios here are not as pronounced, as his investments have not had as long to compound, which also makes failures or near failures more common. The takeaway being, the longer the time frame, the higher your chances of success. Saying that, There are versions of this strategy that can work over very short periods of time if you are near or past pension access age, but they involve very different approaches to investing, so I'm going to cover that in another video. Going back to our 15-year base case, there was one other scenario that I wanted to investigate. Here, we're using a 100% stock portfolio. That's a high-risk portfolio, which is not likely to be suitable for most people. So I was interested to see how a lower-risk strategy of 60% stocks and 40% bonds would have performed. I struggled to find any aggregate global bond data going back to 1972, but I did find data from the Bank of England for 10-year UK government bond returns. Ideally, we'd have a more diversified, shorter maturity bond allocation, but this is an okay proxy. And these were the results. In every single period, it was successful. When I showed this to Tom, he was shocked because he thought, given that stocks tend to outperform bonds, a 100% stock portfolio would do better. But we need to recognize that what is causing the failures is stock market crashes. And if we look at how bonds have performed during those stock market crash years, we can see that they're either up or not falling quite as much. And by combining stocks and bonds into a portfolio together, by diversifying, it has the effect of reducing the impact of stock market crashes. But because bonds have delivered lower returns on average, it also limits the upside. This is a fantastic lesson that actually has nothing to do with mortgages. By choosing to invest in a lower risk portfolio, yes, it's likely that you will be giving up some upside, but it should also help reduce the downside. It should give us a narrower range of potential outcomes, which is exactly what we see here, which can be hugely beneficial if you have a liability that we need to pay for in the future, whether that be paying off a mortgage or producing retirement income. It's important to remember that even though this was successful in all of the periods that we looked at, it could fail in the future. And I'm also not saying that a 60-40 portfolio is the best to use. Depending on your attitude to risk, you might be comfortable with a 100% stock portfolio. Tom thought that this data looked very compelling, and as someone that is comfortable with risk, he liked the idea. But then we looked at this from another perspective, and it completely changed his mind. But before we get into that, there are some other pros and cons that we need to consider before we can fully evaluate this strategy. Firstly, we can see that the worst performing periods are when Tom has to repay his mortgage during or right after a stock market crash. We all know that selling your investments during a stock market crash is the worst thing that you can do. But if Tom has no flexibility on when he has to repay his mortgage, he's running a big risk. Which is why, if Tom was actually going to follow this strategy, he would want to extend the term of his interest-only mortgage for as long as he can. He's 45 now, and his lender should allow him to extend the term up until 65, if not 70 years old. It's important that he does this whilst he's still working, as it will be much harder once he's retired. There is no additional cost to this. It would give him much more flexibility, and it would enable him to be much more tax efficient with how he draws money from his pension. Tom needs to be mindful that when he does draw money from the taxable part of his pension, he will trigger the money purchase annual allowance, which means that if he returned to work, he would be limited to only being able to put £10,000 per year into a pension. That is not a problem for him as he plans on retiring, but it might be for others. The age at which you can access money in your pension is 55, but from 2028, that is set to increase to 57, and it could rise even further in the future. Increasing the term of the mortgage helps to get around this problem, but this is one of the reasons why I think that this strategy should only be considered if you have other assets to fall back on outside of pensions. Perhaps if you are also saving into an ISA, have buy-to-let property, or you're planning on downsizing at some point in the future. But what if Tom dies and his family are left with a big mortgage? Well, if he dies before the age of 75, his family will inherit his pension as a tax-free lump sum, meaning that they are likely to be better off than if he'd had a repayment mortgage. Whether Tom decides to stick with his repayment mortgage or to follow this strategy, the biggest risk is that he falls ill and is unable to work and cannot pay his mortgage, which is why it's not only so important to have an emergency fund of cash, but to have the right insurance cover in place before you think about doing anything like this. Tom will also need to be mindful that the maximum he can put into a pension each year is £60,000, unless he has carry forward available. And although there is no longer a lifetime allowance charge if his pension grows above £1,070,000, there is still a limit on the maximum tax-free cash he can draw. And finally, to qualify for an interest-only mortgage, you typically have to have a loan to value of 50% or less and a personal income over £75,000 or £100,000 as a household, which is why I would only expect to see this particular strategy being used by people that are higher rate taxpayers and have already paid off a significant amount of their mortgage. But Tom had all of these bases covered. So why then did we decide that this strategy was not for him? When you look at this data, it almost seems easy. You would have been better off investing in almost every situation. And that is true if you're a robot. What this data is not showing us is the journey and the emotional turmoil you would have had to endure to achieve each of these results. It's like Inception. We keep having to go a level deeper to find reality. The period between 1999 and 2013 was a success, which would have left Tom with £135,000 in his pension. But I asked Tom to imagine himself back in 1998, but with all of the same fears and aspirations that he has today. Over the last 5 years, stock market returns have been stellar. So you've decided to switch to an interest-only mortgage, planning to execute this strategy. You get off to a good start, up 22% in the first year, but then the dot-com bubble bursts. The markets start to fall. Then 9/11 happens, the markets fall again, and they continue falling into 2022. 3 straight years of markets falling 15 to 20% per year. That is going to be painful. And then when markets did finally recover, we were then hit with the great financial crisis. Stocks fell by 35% in a matter of months. And this time, it really did seem different because it was the financial institutions that we were investing through that were falling down around us. Headlines were predicting the end of capitalism. People were being laid off, losing their homes. Your investments are down and you still have a big mortgage hanging over you. Yes, it came good in the end, but if you had sold at any point, it would not have. So I asked Tom to picture himself in those moments. What would you be saying to yourself? What would you be saying to your family? You need to really think about how you would feel, how you would react, and whether the reward is worth the pain, because we will see these types of events happening time and time again in the future. I said to Tom, I know that you're comfortable with risk, but like most risk-on people, you're taking high levels of risk in lots of areas of your life. You are already investing a lot, and those investments are in 100% stocks. You have 30% of your net worth tied up in shares for the company that you work for. You've chosen to keep a low cash buffer, and you work in a high-risk sales job. I mean, you've been laid off twice in the last 15 years. So even if you think this strategy makes sense in isolation, it doesn't when we zoom out and think about your bigger picture. So ultimately, after all of this, we decided that this strategy was not for Tom. But he walked away from that conversation with a much better understanding of how data can be deceiving and why you often need to dig deeper to find answers. What risk really means and why sometimes less risk can be helpful. How powerful pensions are for boosting returns and why it's so important not to make decisions in isolation. Why you need to zoom out and consider your unique personal circumstances. And I hope that you guys now have a better understanding of all of these things too. So if you have enjoyed this video, please do give it a like and make sure you're subscribed because it really does help to support the channel and get this content out to more people. You can also find links to all of the graphs down in the description if you want to take a closer look. And if you do still think that this strategy might be right for you, I would highly encourage you to watch this video here where I talk about it in more detail. I'll see you there.